Hi, agents. I am super excited for today's topic. How does the mortgage cycle work? And if you've ever asked me about it, I get super excited because I love this topic because I love to educate people and explain to them how it works. So that's what we're going to cover today. Now, stay with me because the video might be a hair long, but I promise you, when we complete that mortgage cycle, it's all going to click. It's going to be like a light bulb just went on. And I'm going to try to show you some other examples of things that you might be able to understand better to give you, to put the pieces of the puzzle together so you can understand the whole mortgage cycle. So to start off, what you need to understand is underwriting has very limited because it doesn't necessarily matter if the borrower makes sense, if the loan makes sense. All that matters is, can I sell this loan? Because you see, loans are sold on the secondary market. And it's all about how quickly a lender can offload that loan off their books and onto somebody else. So take into account life insurance. If I was going to go get life insurance, they're going to look at me and say, okay, Rebecca, you're white, you're female, this is your health record, this is how old you are, and they're going to put it all together, give me a premium, and I'm going to pay it. They're going to issue me life insurance. Why would you want to issue me life insurance? They know I'm going to die one day, right? I'm not going to live forever. But you see, the life insurance companies, they can manage risk. They can put it all together. There's going to be some files, some loans, or not loans, insurance that they end up paying on. And there's going to be some they make money on. They know how to manage the risk. And mortgages are kind of the same way. Because you see, what we care about is not necessarily risk on the borrower. We know people are going to get foreclosed on. We know that there's going to be short sales. There's going to be people not making their payments. We can manage that risk. The risk that we cannot manage is interest rate risk. So let's look at an example of interest rate risk. So here, let me close out of that stuff so you can see it a little bit better. Take Barry here, and he has a $100,000 loan to Dan for 3% interest. How much interest is Dan going to pay Barry on that $100,000 loan? And the answer is 3%, right? Very simple math. But what if the next year interest rates rose and now they're 6%? Is the loan that Barry is holding still worth $100,000? How much would he have to invest in a 6% environment to still earn that same $3,000? And the answer is $50,000. So if he invested $50,000 at 6%, he would make $3,000. So going back to the previous question, is the loan that Barry is holding still worth $100,000? No. Barry would lose about half of that money if he was to sell it today in a 3% environment. So you can see how interest rate risk can be very detrimental, because if you lend somebody $100,000, that's a lot of money. But put yourself in a lender's shoes. A lender might have $2 billion in loans outstanding. That's a lot of money. And if they lost half of it in a second, it could put them under. So that's why mortgages care about interest rate risk more than anything else out there. So let's walk through the mortgage cycle. So we had Mr. Borrower, and Mr. Borrower wants to buy a house. So he decides to go to a loan originator. Another name for a loan originator is loan officer, mortgage advisor. We get called all sorts of names. So he goes to the loan originator, and the originator says, okay, I can get you a loan at 6.5%. You say, great, let's move forward. But the originator is not the one who's actually loaning the money, right? No, they're not. They're going to write the loan through a mortgage company. And the mortgage company is going to say, okay, well, we're willing to do this loan for you, but there's risk here. This is a hot potato that we're holding. So we're going to pass it along. Now, a mortgage needs things to be serviced on it. Someone has to collect your payments, pay the taxes and insurance. Someone has to send you that nasty note when you don't make your payments. Someone has to take care of your payoff statements, your balances, answer your questions when you call in. And that's the mortgage servicer. Now, they're going to get paid to do this, right? They want a fee to do this, just like the originator got a fee for originating the loan. The servicer wants a fee. Now, the servicer doesn't want to hold this hot potato either. They want to get rid of it. But that is who my payments are made to. And this is where everyone gets it wrong. But they are holding my mortgage. No, 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 no. They got rid of that hot potato. They're not holding your mortgage. What they are holding is the servicing rights to that mortgage. You see, a servicer is a lot like an apartment building. An apartment building has a super, and the super is going to collect the rent payments. They're going to take care of the maintenance. They're going to rent out the units when they're vacant. They're going to service the building. And that's the same thing a mortgage servicer is going to do. They're going to service the loan. So where do the mortgages go then? Well, in many cases, about 70% of them go to the largest aggregators out there. But before they do, the servicer is going to make money on that loan. A servicer gets paid 30 bips, that's the 30 BPS right there, or 0.3% of the loan amount every year. And oftentimes, they have to acquire the servicing. And in order to acquire servicing on a loan, it usually costs 1 point, or which 1 point is 1% of the loan. So as you can imagine, it takes a little over 3 years to break even. And even if the servicer also originated the loan, because there are cases in which that happens, instead of selling the loan, they lost out on making that 1 point. So either way, it takes them a little over 3 years to break even. And don't forget, they're going to want paid up front for that. Now, as I mentioned, they're going to offload this mortgage to the largest aggregators out there, Fannie and Freddie. Now, you see, they're part of the FHFA, which is the Federal Housing Finance Agency. And at times it's going to vary, but usually about 2/3 of all mortgages are sold to Fannie and Freddie. Now, they're going to aggregate the mortgages. Fannie and Freddie are going to use economies of scale to pull together the loans and create big bundles of loans. You see, they're pretty smart. They don't want to hold this hot potato either. So they take a fee, they collect a fee for aggregating the loans, and they pass them along. The benefit in aggregating them into a large bundle is they can combat time. Because remember, what's moving in the background? Interest rates are moving in the background. They have a limited period of time to offload these loans. And that's why your interest rates are locked in 30, 45, 60-day increments. Not because it takes us that long to process the loan, but because they want to set a limitation on how long that interest rate movement is in the marketplace. The larger the bundle that they can accumulate within that period of time, the easier it is for them to go to Wall Street. Now, Wall Street's going to take a fee too, right? That's right. Wall Street's going to take a fee. And what they're going to do is they're going to underwrite these loans. They're going to securitize them, and then they're going to turn them into what's called MBS, or mortgage-backed securities. And then they're going to sell them. Now, remember, there's a lot of risk here. Who in their right mind would want this risk? It could go up, it could go down, it could make money, it could lose money. Well, guess who? You and me and your brother and your sister and your best friend. All of us. We are all taking this risk. If you look at what's in your mutual funds, your IRAs, your 401ks, there's a lot of mortgage-backed securities in there. And in fact, the same people who are borrowing the money right here are the ones lending it through their retirement accounts. Now, here's the thing. Everybody thinks over here at the mortgage company, it's the underwriter who is coming up with the guidelines. But that's not the case. Underwriting does not work forwards, it works backwards. And that's because the investors over here on Wall Street, these investors are going to say, hey, we're only taking loans that have a minimum FICO score, minimum credit score of 620, and we won't do it unless they are putting 3% down. So then they're going to go back to Fannie and Freddie and tell them that. Fannie and Freddie is going to tell the servicer, hey, these are all we're buying. The servicer is going to say to the mortgage company, I'm not buying that loan unless you meet this criteria. The mortgage company is going to tell the originator, and that is who tells the borrower, hey, this is the standards for underwriting these days that you have to meet. Because it isn't if the loan makes sense. We don't care if the loan makes sense. All we care about is, can we offload this hot potato or not? All that matters to everybody here is, can we sell it? Now, the last thing I want to point out here is the borrower over here, they paid 6.5% on this mortgage, right? They're the same people that in their investment accounts, they're getting a 6 or 5.5% coupon. And that's because Wall Street took a fee, Fannie and Freddie took a fee, the servicer took a fee, the mortgage company and the originator all took a fee. Everybody has to get paid. And that is going to explain the mortgage cycle. So I hope you learned something there. Like I said, it's one of my favorite topics. I love going through it. If you have any questions, don't hesitate to reach out to us. But that's the gist of the mortgage cycle. There's a couple other pieces and components, but we didn't want to overly confuse you today. So I hope you learned something. If you did, please reach out, give me a like or comment. Don't forget to subscribe to our channel because we love bringing you this educational advice, and we hope that you can pass it on to your clients.